more people, if you own your home, congratulations, you own an alternative asset. Anything that's not a
Right.
stock or bond, real estate is considered an alternative asset. The focus goes up and down depending on them. I would say the biggest variance, especially with some of our largest clients, we have some people who have closely held business interests that you might call private equity that are in the tens of millions of dollars range. And that way you might say they're more focused on the alternative space. But the majority of our clients, I would say, are focused on the public markets. And then we use the alternative investment space to complement that.
Hey, everybody. Welcome back to Break Free from Wall Street, the podcast where we talk about all things in the alternative asset space today. Super excited for you guys. We are joined by Luke Wanacott of PROFI. He has experience in the financial advisor space, and we're going to get into tax strategies. We're going to get into all the experience that Luke has to offer us. Luke, welcome to the podcast. Really, really glad that you were able to lend us your time today and your knowledge.
Of course. Thanks, Nick, for having me on. I'm happy to be here.
Absolutely. So, Luke, just to break the ice, I want to learn more about you, your background, what brought you to PROFI, and what you do at PROFI now today.
Of course, yeah. So I got my degree in finance from BYU. And as part of that process, I was learning about the different areas of finance, and the personal finance space really spoke with me. I love working with people, individuals, and that's really what personal financial planning brings to the table. So I went through that education program. I also, during that time, passed my certified financial planner exam and my enrolled agent exams. So I work kind of as a tax specialist within the firm, as well as a more generalist financial planner. And our goal here at PROFI is to help members of the local community. So we focus a lot on Utah County specifically, and helping them sell their businesses and retire to live a better life.
That's awesome. We're all about retirement in at Safeguard Advisors. So yeah, really aligns there. You mentioned that you both hold the CFP and I believe it's the IRS Enrolled Agent designation.
Mm-hmm.
I feel like most financial advisors either have one or the other. What made you go after the tax side on top of that more planning focused credential with the CFP?
Absolutely. Here's what I've seen is that when you deal with high net worth clients, there are a few particular areas of expertise that a lot of them are looking for. Okay. The first one is obviously investments. You have to know your investments. You don't, and not just stocks and bonds, but everything. Because even if you're not necessarily pushing it, when your client asks you about Bitcoin, you better have a dang good answer about whether or not you should have Bitcoin in their portfolio. So, so that's the first area of expertise. And I have found that tax is a close second. Most
Mm,
people either have a financial advisor that doesn't give them tax advice, or they have a CPA that also doesn't give them tax advice. It's very common to have investment expertise, and maybe they can file your taxes for you. But as far as actually strategizing to lower taxes, it's something where the demand is here and the supply is a lot lower. So I would say at PROFI, we probably spend maybe 30% of our time with clients working on investments, and then 30% of our time working on tax reduction strategies. And then the last 40% is everything else. So we're looking at estate planning, we're looking at retirement, we're looking at insurance reviews. Those are all the other areas that kind of complete the holistic financial plan. But I
mhm.
found that those two, when you're dealing with people who have $1, $2, $3 million that they want to invest, they're not just worried about returns, they're worried about returns net of taxes. And so you've got to be worried
Right.
about it.
Yeah, absolutely. Just essential when you're working with a certain group of people, certain group of investors. Definitely agree. Would you say, I guess you may not have an exact number for this, but if you had to guess, if you had to speculate, how many of your clients would you say are investing in the public markets, stocks, bonds, mutual funds, those conventional assets versus clients who are maybe a little more focused in the alternative asset space?
Interesting. So, to answer your question, 100% of our clients are invested in public markets. Now,
Hmm.
that can be through IRAs, 401ks, through regular brokerage accounts. 100% of our clients have that, but also 100% of our clients have some form of alternative assets. And it's really interesting because more people, if you own your home, congratulations, you own an alternative asset. Anything that's not a
Right.
stock or bond, real estate is considered an alternative asset. And so the focus goes up and down depending on them. I would say the biggest variance, especially with some of our largest clients, we have some people who have closely held business interests that you might call private equity, that are in the tens of millions of dollars range. And that way you might say they're more focused on the alternative space. But the majority of our clients, I would say, are focused on the public markets, and then we use the alternative investment space to complement that.
For sure. Yeah, definitely not putting all your eggs in one basket. Obviously, got to diversify. So, uh, love that. So I wanted to tap into something that I saw when I was looking into ProFi. I think ProFi on the website somewhere it said that only 6% of financial advisors are providing what you guys would call like advanced planning, um, tax mitigation, wealth protection, wealth transfer. Um, why do you think that I mean, according to this, why do you think 94% of other advisors are skipping this type of planning?
Well, here's the thing is that investments as a single service is extremely scalable. So start with this big funnel at the top that you have all financial advisors. The biggest bucket, I would say probably in the 80% range, is going to be your big names, your Fidelity advisors, your Merrill Lynch people, people at Wells Fargo, JP Morgan, that are dealing with generally these mass affluent clients, that 250,000 to $1 million range. And inside of those firms, you can't give tax advice. Like, if you, who's listening to this, if you have a Fidelity financial advisor, go ask them some specific tax questions. And they'll tell you, talk to your CPA, or maybe they'll give you some general information and then follow it up with, but I can't tell you about your specific situation. You have to talk to a tax expert. So that's the
Right.
difficult thing, because these big wirehouses, they're built to just do investments because it's very profitable, very easy to scale. It doesn't take a lot of work to upkeep. Now, you bring it down a notch and you say investments and tax strategy, and already there you're losing that 80% of people, because it's so much less scalable to go into somebody's individual situation on both the tax and the investment side. And then you scale it down even further when you start including things like estate planning, like insurance reviews, like retirement planning. And you end up with this very small subset of advisors that are actually able to look at your entire financial picture and advise on all parts of it. So it's not as scalable. It's not as easy to get a lot of money coming in as a company, but it is a whole lot better for the end client.
Right. Maybe not in the business model for a Schwab or a Fidelity, which is exactly why they don't do what Safeguard does with the self-directed IRAs. They have like some type of like self-directed IRA plans, but if you're going to them to say, "Hey, I want to invest in real estate with my retirement funds," they're gonna say, "Great, we can't do that, but we have these lovely products on our shelves. We have what about this lovely ETF on our shelf?" And they can do that very well, very efficiently, but really doesn't benefit their business model to be able to allow you to invest in those alternative assets like real estate, crypto, and these other things. So I think it is important to have both advisors and other solutions that open your capabilities up to these other avenues. So I really like that. I think we were talking about this before we hopped on here, that 80% I think of all of our investors are investing in real estate in some fashion, whether that's, tax liens, tax deeds, syndications. I think real estate has generally a reputation for being tax friendly, with depreciation, deductions, 1031 exchanges. Um, do you feel like that reputation is fully deserved, or is it more complicated than some advisors may make it sound? Is there additional things to keep in mind when you're investing in real estate?
Yeah, no, real estate is absolutely tax favored. There've been a lot there's been a lot of lobbying for a very long time, and in the United States it's a cultural thing. Like owning your home is so culturally important in a way that it isn't in a lot of other parts of the world. And because of that, we have built a lot of favorable items into the tax code for real estate. I would say the biggest thing to keep in mind when you're doing any kind of real estate strategy is that most real estate tax benefits are deferrals and not necessarily tax savings. Okay, so what does that mean? If I buy a piece of real estate and let's say I get $100,000 of depreciation, that lowers my income for this year. Let's say I get that. Um, the IRS, when you go and sell that property, you have to pay taxes on the depreciation that you took. So it's called depreciation recapture. And there are ways to continue to defer it out through 1031 exchanges. There are ways to continue to get this deferral. But you have to keep in mind that unless you're planning on holding properties all the way until you die and never seeing your principal again, there's a good chance that you're going to get some depreciation recapture at some point. And so, again, not saying that that makes it a bad strategy, but it's often not talked about that there is this depreciation recapture that you're going to face at some point. And if you run the numbers with the depreciation recapture, it usually makes it a little bit less crazy attractive, like you might want it to seem. So I would just be careful and keep in mind when you take that depreciation, accelerated depreciation, know what's going to happen with that in the future.
Absolutely. And a lot of our clients are investing in real estate through self-directed IRAs, solo 401ks, meaning that the investment itself lives inside, a tax sheltered retirement account.
So you're not
From
getting any tax benefit from the depreciation
r-
or anything like that.
right, exactly. So with from your frame, how does that change the tax picture compared to owning the same property, outside of a retirement account?
I would just say at that point, it's the same tax advantage of using a regular investment account. So, like if you go to Schwab and you open a Roth IRA versus a self-directed Roth IRA, so tax treatment is exactly the same. So at that point, the only question is the investment performance going to be the same? And so now you kind of remove the tax question from it, actually, in my opinion. And now you're just looking at investments. What is going to give me the best return?
Right. And is it some combination of the two? We have clients who come to us a lot of the time and say, like, how much do I take from my traditional IRA at Schwab? How much do I transfer over to a self-directed IRA to invest in real estate or crypto or any of these other alternative assets? And, we're not tax, legal, or investment advisors in any way. So it really comes down to your personal strategy, your preference, your risk tolerance, and all of these things. Um, how do you handle from your perspective with your experience, how do you handle helping people navigate the way that they're looking to diversify their retirement?
Yeah. So I would say there are a couple of big things to keep in mind when you're looking at using any kind of alternative asset as part of your portfolio. I would say number one, which is a big one, is liquidity. And number two is going to be what kind of other costs are you incurring and what kind of an investment is this? So here's the thing is you look at a diversified stock market investment, and generally there's a ton of research and there's a ton of literature on exactly what you're getting out of your stock or your bond investment. And that doesn't necessarily mean it's safer per se, but it may be more predictable. When you get into the alternative asset space and you're looking at using self-directed IRAs, things are a little bit less predictable, and that means the onus is on you to be doing the research for your investments. And I would say most people have a lot of trouble doing proper investment research and often get caught up in stories and get sold on things that aren't necessarily in their best interest. So, starting point for someone, we generally like to keep about 80% of the portfolio in more traditional stock and bond market investments. And then we allocate up to 20% to the alternative space. And so, let's say you take this 20% and you put it into a self-directed IRA. Now you're looking at options like gold and Bitcoin and real estate held inside of that. And you just have to go back and look at the research. Don't just buy any story that somebody's selling you on. Go look at the research. What is the risk return or profile of gold? What are the chances that your Bitcoin could go to zero? What are the costs involved in this real estate investment? Because a lot of real estate, a lot of the time, and all of these investments can have a lot of commissions and a lot of extra costs. So make sure you're comparing apples to apples when you're looking at stock market investments versus these alternatives. I think that's where most people get tripped up, is they see headline numbers and they don't dive deep enough to understand what the risks are and where the returns are coming from.
Yeah, I think that's a really big thing that we see on our side as well, is people who maybe really don't have an asset class that they understand, but they just heard that, you can self-direct and there's all these success stories that people hear. But at the end of the day, it really isn't for everybody, but it is for the people who have assets they understand, they have previous, proven success through strategies that they've done personally. And with that experience, they can apply that same, really that same financial strategy, that same cash flow to their retirement accounts. But it's definitely, I don't think as tailored for a person who maybe is just starting out in real estate and starting to, bet their retirement on figuring that out, so to speak. So, definitely something to for sure keep in mind. What do you feel like, just going more to the general real estate side? What do you feel like the most common tax mistake that you've seen for real estate investors to make? Like the one thing that costs them the most money that is entirely preventable.
From a tax perspective,
Yes.
from
Hmm.
a tax perspective. Okay. I would say the number one thing that I think causes the most tax headaches when you're looking at pieces of real estate, and this is something I've seen, is when you inherit a piece of real estate
Mm,
and wait to decide on what you're going to do. I would say when you inherit a piece of real estate, there's a law in the US called the step up in basis. That means when your dad passes away and their family home passes to you, he bought it for $10,000 and now it's worth $1 million. If he sells it in his lifetime, he has to pay capital gains tax on that difference. But when it passes to you, if you sell it right away for $1 million, then you don't have to pay any capital gains taxes on it. Okay. But if you wait and you either just don't bother or you are not sure what you should do and you wait 2-3 years before you actually sell this property, then you're going to end up with these huge capital gains. And then it becomes a question, oh, I don't want to sell this because I'm going to have to pay taxes on it. And then even if it's a
wow.
bad investment, even if it's getting poor returns, people hold on to it because they
Just
have these
because.
embedded gains, just because they don't want to pay taxes.
Wow.
So
That's
that's the
crazy.
biggest
And it's
mistake.
really just 2 to 3 years. You could procrastinate for 2 years. And I mean, especially when you do have, the death of a loved one. I mean, that comes with a lot of baggage and a lot of figuring things out with, different people. So I feel like that's something that's really easy to let slip through the cracks. You're already dealing with so much, the grief of it, personal relationships with your family can change in that time, and then you just have this other thing hanging over your head. But that is I didn't realize it was, you go from paying 0 taxes by making a simple decision to paying, like, all of the capital gains. So it's the lifetime of that asset? Is that what you said?
Yeah, so uh the day that the person passes away, all of their assets, the basis increases to the level it was at the time they pass away. So if I own a house, again, same example, I bought it for 10,000 and it's worth a million, and I die on January 1st, then now the new basis for this property is $1 million. So you sell it right away, you have $1 million basis, $1 million sell, cancels each other out, there's no gain. But if you wait a year, maybe it's worth 1.1 million. Now,
Mm,
that doesn't quite cancel out, and you have $100,000 gain that you have to pay on. So,
for sure. Yeah, and definitely something that can, uh, lock somebody in to an asset that, like you said, is not cash flowing maybe the way they want it to. That's super interesting. When does it actually make sense, for, a real estate investor to hold a property, um, outside? I want to bring it back to, the retirement space, which we work in pretty heavily. When do you think it makes more sense to hold a property outside of your retirement account as opposed to inside your retirement account?
yeah, that makes a lot of sense. I would say that comes down a lot to your personal situation. So hard to give any general ideas without knowing the specific situation. But I would say, first of all, a big thing is, like I said, if you're looking for those tax benefits, the real estate inside of an IRA doesn't necessarily have all of that. It's just as if it were any other IRA investment. It's completely tax deferred. So if you're looking for tax benefits, self-directed IRA is not necessarily the place to go with that. You won't get any tax benefits unless you're holding it outside of that IRA. Uh, so that's a big situation when you want to have it outside. Also, I would just say everybody, when you're saving for retirement, the best way to strategize from a tax standpoint is to have some amount into three buckets. So you have your traditional IRAs, your pre-tax 401ks, that's one bucket. You have your Roth, so Roth IRAs, Roth 401ks, and then you have your after-tax bucket. So this is your outside of the IRA. So if you only have Roth IRA and IRA money, then it might be worth starting to build up at least a little bit outside of that, because that gives you a lot of flexibility from a tax planning perspective and from an early retirement perspective to do whatever you want. And it doesn't restrict you as much as an IRA might.
Mm, I think that's valuable as well. Um, what I want to kind of look at now is kind of the big picture. Um, if someone is really serious about building wealth through real estate, what would like the beginnings of a comprehensive, financial plan look like for them beyond just, picking the properties themselves?
Absolutely. So, like, if somebody came to me and they're like 25 years old and they want to build a career in real estate that's going to bring them wealth, is like you're just kind of asking where I would go from there, where I would start out.
Yeah, what's the first, even somebody, maybe they're not, like in the prime of their life, maybe they're just, maybe they're mid 30s, early 40s, maybe they're looking to build wealth through real estate in some fashion. I guess it will depend for sure. Um, Person to person, situation to situation, what that looks like. But in general, when you're building a a financial plan to help somebody generate wealth through real estate, what does that look like in most cases?
Yeah, absolutely. So, most of the time when people are looking to build wealth through real estate, um, first of all, you're going to need some kind of income source. So whatever you're doing for your day job, we're probably going to need that at least to start you out. I would say that's one big thing. And the other big thing is the education portion. So somebody who comes in with no knowledge of finance, and you might disagree with me on this, Nick, but I would say if you don't have the knowledge, I would much rather you be in public markets than try to play the real estate game, because you can get burned a lot harder, a lot quicker if you don't have any idea what you're doing, versus with a well-diversified portfolio in public markets. So I would say start out with your job, don't quit because you're going to need that cash flow to get started, and get educated. Like seriously, go take some finance classes at a local community college. Go have lunch, take some real estate agents out to lunch, take some real estate investors out to lunch, and figure out what niche you're going to fill in that market to build wealth. There are two things in real estate that make you wealthy. The first one is leverage. Okay, so you're taking on a ton of debt so that when your investment goes up a little bit, you make a lot of money. Okay, so that's number one. So you need to understand that because it's dangerous and it can make you go bankrupt if you use it unwisely. And then number two is that real estate is an inefficient market. That means that you can sometimes go and find deals that are selling for way less than they should be selling. And so if you understand how to find the deals that are going to make you a lot of money and how to use leverage wisely to increase your returns without having too high of a risk of bankruptcy, if you understand those well, then you're going to have a good career in real estate.
Yeah, and I completely agree that if you don't have the knowledge to be able to get into real estate, that you definitely need to start somewhere before you jump headfirst into the water. Like you said, when you're looking at especially utilizing leverage, that is something that does carry just like an inherent risk. So yeah, we're all about education and definitely learning as much as you can about not only self-directed IRAs but the assets that you're looking to invest in. And so I would definitely say that like I said before, I'll say it again. It's the self-directed IRA is not for everybody. Real estate is probably also not for everybody. Crypto is also probably not for everybody. Tax
Maybe
liens,
not. Yeah.
we have people. You can invest in anything allowable by law with a self-directed IRA. We have clients investing in like just some odd ones, apiaries, like bee farms. We have clients investing in like music royalties. That doesn't mean that everybody needs to invest in a bee farm. Not everybody needs to invest in music royalties, production royalties for like TV and the movie industry. But those are things that people have found success in because they know those investments backwards and forwards, right? So it's really about utilizing leverage, right? With real estate, it's also utilizing the leverage of the knowledge that you have of, the space that you're in and the expertise that you have. So I 100% agree with you there. Um, for I think one more thing I want to touch on. A lot of people, I think, in our audience and just generally have have some type of distrust for traditional financial institutions or advisors, feeling like they're being pushed into products or investments that will serve the advisor on the back end more than they may serve the client. How do you consider that criticism? How do you think about that? How does PROFI take that into account when serving their investors?
Yeah, it's a very valid concern. My opinion is that financial advisors have a well-deserved poor reputation. So
Mm,
think back to me, the funnel, 80% are at these big firms. And I know a lot of people at these big firms, and they're good people, but these firms are designed to churn out money.
generate
They're
income.
designed to a lot of times sell products to clients. And the focus at a lot of firms ends up being that whatever we can sell to the client that is going to provide the best interest for the business is what ends up happening. Obviously they're not, if you go to their website, they're not going to say that. They're going to say we always
Right.
act for the client. But my experience has been that, especially at a lot of these larger firms, there's a very heavy sales culture, and it's up
Mm,
or out. If you're not selling products, then you're going to be fired. And so at ProFi, we take it very seriously that we are working in the best interest of the client. I have personally seen us turn away and reject $10 million clients because uh, they didn't align with what we were doing, and they wanted a certain product that we didn't think was in their best interest, and we would rather lose that client than be the ones putting them into this product that we don't think is best for them. And so we charge our fees in a way that aligns our incentives with the incentives of the client and is 100% transparent. Any dollar that is coming to us is spelled out in writing and verbally to our clients. So there's no behind the doors compensation, no fund companies are paying us, no insurance companies are paying us. Nick isn't paying me.
Right.
I everything that we do is because we strongly believe it's in the best interest of our clients. And everything that we do for clients, we're doing for ourselves. So if that's any evidence as to how much conviction we have in these strategies, that's what we know is going to work.
Yeah, I like that, and I think you hit it on the nose. I mean, there has, maybe a culture has developed in these larger corporations. One bad apple doesn't make the batch bad. But I think it's really important for our listeners to know that there are institutions, financial planners out there who do have your best interests at heart. But definitely, also, it is a good idea to not just assume that everybody has that same care and consideration for your financial well-being. So for listeners who want to find a financial advisor who actually understand real estate and these tax implications, what do you think they should ask in that first conversation to know whether that advisor is the right fit for them?
Of course, I would say there are a few big questions that you can ask that are going to require certain answers. I think number one, how are you paid? I think that's a really good way to ask. I would say number two is what education, certifications, experience do you have? And number three, what is the scope of the work you do? So the compensation is going to tell you a lot about whether you're going to be sold a product versus having an advisor. And knowing what their experience is going to tell you, okay, does this person actually know about taxes and investments, or is this just some guy who just graduated high school who heard that financial planning, you can make a lot of money?
Hmm.
Because there are a lot of those. And if you ask those three questions, I think you're going to get a really good idea for what kind of your person you're going to deal with. And at the end of the day, it's going to come down to who do you trust to work in your best interest. So I would say ask your friends and family. Who do they use? Do they really like them? Are they just okay? Because I found that most people have in their network somebody who is connected with a really good financial planner. And
Mm.
it can take some work to find that person, but go looking for it. And these people do exist. Not everybody in the financial services industry is out to sell you something.
I love that. Luke, this has been, I think, incredibly valuable information and insight that you're giving us here today. Really appreciate you coming on, lending us your time. Where can people find PROFI? Where can people learn more if they want to look into this more, work with your team? Where should they go?
Of course. So we're just based in Utah County in Orem, 384 West Center Street. Feel free to pop in. Our website is thepfc.com. And if you like what you see on the website and you feel like that might align with what you're looking for in a financial planner, you can give us a call, 801-701-2345. And we're happy to chat and see if we really are the best fit for you or if we can help you find who is.
Awesome. Love that. Yeah. I mean, you got the address. Go and stop by, say hi to Luke and his team. Again, thank you for coming in today, Luke. Appreciate your time. Thanks, everybody, for tuning in. We'll catch you next time.